Okay, so we've kind of just lifted, I guess, the collective intelligence in the room with respect to blockchain and the way it can be used, the appropriateness we're starting to hint at the appropriateness of particular solutions or where blockchain might be in a tech stack. My job is to actually come from the domain. So I'm presenting with respect to agriculture, and this may be super boring because maybe you're all farmers, but I'm guessing that's not the case. So are there any farmers in the room? I can say anything, that is very dangerous. Okay, there was no one who put their hand. I'm a farmer, so I should say that, yes. Are there any farmers in the room? I am a farmer, yeah. Okay, all right, so let's go back. In case you didn't get it, my name's Emma Weston. I'm the CEO and a co-founder at AgriDigital. And at AgriDigital, we are really focused on making supply chains, global agri-supply chains, safe, secure, simple, easy to use. We're a farmer-forward organisation, so we start with the farmer and we think about what is going to make participation in supply chain less risky for the farmer and then indeed for all participants from that point forward. So we are a provider of a platform, and I'm going to go in a little bit to that platform. So we sit at the application layer, but we also are one of the leading I guess proponents of blockchain in the agricultural space. That kind of went a little bit low, didn't it? And I'm going to talk really quickly to how we've applied blockchain to try and ground it a little bit. If you still don't get it, that's absolutely fine, because I reckon it takes about 6 or 7 passes to actually think about how blockchain works and to be independently able to engage with it as a topic and to say, actually, I really do understand what blockchain is and what it's trying to do and how it actually leverages into operational domains. So we're at one with that as a language point. Okay, so the problem from our perspective is that the supply chain is failing, and the supply chain is failing because farmers don't get paid for what they deliver when they deliver. So when a farmer takes goods to market, and bear in mind that in the space that we operate, which is grains and cotton, that is usually an annual crop. So they've basically grown something, they've taken all the risk on all year, they go and sell that to a buyer, and they don't get paid at that point. But what does happen is the goods get taken from them, they get put into a commingled stack, and if there is some problem with payment, there is no way to re-identify that asset and get it back to the original seller of the goods. So I am speaking to a highly educated room, which you can see the problems in that particular scenario, I'm sure. Does it happen? Do you think it happens? Yes, it does. So in 2014 in Victoria, that's our last lot of reliable stats, $70 million was lost by wheat farmers alone because they were not paid for wheat that they delivered into the supply chain that you and I later consumed. And the reason they weren't paid was because liquidators came in, they couldn't re-identify an asset and return it back to the farmer. The farmer couldn't prove that they had grain that they hadn't been paid for, and they weren't able to participate in a liquidation process in any other capacity except as an unsecured creditor to an already failing business, and so the secured creditor took everything. That same year, $30 million was lost in New South Wales in exactly the same way. So $100 million in 1 year. The grains industry is worth around about $9 billion if you actually kind of put everything in there, but more around the kind of $1 billion mark just from a wheat perspective. So we're actually talking about a really, really large chunk of the market in that particular year in those states. So farmers want to get paid for what they deliver when they deliver. That seems pretty simple. What they basically want is just like when you and I buy a coffee, we want to get the coffee and hand over the money. And that's actually a really difficult thing. And if you work in financial services, you will know that's called DVP, delivery versus payment, but very, very difficult to execute in the physical world. So we want to change that. We also know that one of the reasons farmers don't get paid for what they deliver when they deliver is in fact they're selling to buyers who don't have the money to acquire it. So those buyers are not using their own balance sheet, they're using other balance sheets. So the ability to access liquidity into the supply chain is a fundamental piece here, and blockchain has a role to play in terms of being able to introduce new liquidity into supply chain. We may not get time to go into that today. The third problem that we're really focused on is that if you think about supply chain, all it is three things: trade flows, finance flows, and other data flows. And at the moment, all three of those happen completely independently of each other. So the proposal that we put forward is that that is rubbish, that we should actually have trade, finance, and data all sitting within one pipe of information, if you like, that can then be leveraged across a network of users. And so by that, I mean that if you are financing into the supply chain, you actually have a view to the underlying asset that you're financing. You understand where that asset is at any point in time. Okay, so they're the problems. The solution, we think, is a supply chain that is embedded with digital trust. And there are a number of different ways that we could go about trying to solve for this. The way that we have gone about it is we've created a digital commodity management platform that is multi-participatory. So from farmer through to consumer, as you can see in that value chain that's up there, that's a typical supply chain, by the way, for the export of wheat in containers. So to demystify a little bit, DCT stands for Delivered Container Terminal. CIF is Cost Insurance Freight. I think everything else is pretty self-explanatory. But basically what we want to do is ensure that the supply chain enables us to track an asset all the way through from farmer through to consumer, so that we understand where our food, our fibre, our fuel is coming from, so the provenance of goods, but also so that we can ensure that the value exchange that happens between participants is done in a way that offers payment and transaction security. And if we can also build out novel financial solutions, that's also fantastic. So this is really tapping into the fact that when we built the internet, we didn't know that a major use case was going to be, what's one I'm going to choose? When the internet first came in, we didn't know that one of the major use cases was going to be buying shoes online. In fact, what a stupid use case. I can just go down to a shop and buy shoes. But in actual fact, there's been around about $1.7 billion funded by VCs into online shoe stores. So this has been you may say that's a crazy idea, but it's actually been a successful adaptation of the internet as a commercial application. And we're yet to see what happens from blockchain. So I'm just going to give a really, really quick example of blockchain in action. The settlement that we did in December 2016, which is a long time ago now, it actually feels like kind of almost embarrassing actually to talk about it because it's so simple. But what we wanted to do was the farmer to sell to a buyer. So we wanted the farmer to deliver their grain to a buyer, deliver it into a pack house, and be paid for that grain at the time that they literally put it into the silo. And in order to do that, what we needed to do was build out the ability to understand the quantity of grain, the quality of grain, to have a predetermined price that we could apply across that quantity at that quality to come up with a valuation of that load, to then create a digital asset that was a representation of that load of grain, and to put that digital asset into the buyer's wallet. I can put that down for the moment. So we've got the buyer's wallet here, and it's got digital grain in there. What we then needed to do was, before we actually transferred that digital grain to the buyer's wallet, did I say the buyer's wallet? So that's the grower's wallet with the digital grain. Before we transfer that digital grain to the buyer's wallet, we need to make sure that the buyer has enough money to pay for it. So in this particular case, what we did was we replicated the buyer's bank account, and we issued the buyer with AgriCoin that effectively was pegged to what they had in their bank account. So they had a cryptocurrency sitting in their wallet. We built a very simple smart contract that said, first of all, create a digital asset if these conditions are met, and these were largely around contract conditions. Is it this quantity? Is it this quality? Is it delivered within the right period, etc.? Has it been delivered to the right location? And if all of that meets, go and search in the digital wallet of the buyer to see if there are enough funds. If there are funds there, reserve that in the name of the grower, so we can't spend those funds. And then, when we have that reservation complete, and we actually have the last precondition satisfied in the smart contract that is governing the interchange of value, and in this case it was that there had been a physical delivery of the grain. So the grain was actually going into the silo, and at that point released the funds. So we basically then had what's called an atomic swap. So what we basically did was took a series of sequential transactions and collapsed them down into one simultaneous transaction. And that's essentially the smarts of a lot of what sits in smart contracts these days. So as I said, very simple. The grower went over a weighbridge, we valued the grain, found that there was money there to pay for it. The grower delivered, and they were paid before they had left the driveway of the buyer, which was just the first time that had been done globally. So it generated a lot more interest than we thought that it would. A more complex transaction that we did with Rabobank. So this was taking a structured inventory product, and if you work in financial services, once again, you'll know these are reasonably complex products. From Rabobank's perspective, there were about 136 sequential steps that are executed over a 6-week period in order to get money from Rabobank through the buyer to the grower so that the buyer can acquire the grain from the grower in an off-balance sheet transaction facilitated and funded by Rabobank. And haven't got time for guesses around what you're able to collapse that down to, but using smart contracts on a blockchain, we were able to get that whole process collapsed down to 50 milliseconds. So we're talking huge orders of magnitude in terms of back office as well as risk mitigation around settlement latency. Because if you have 136 sequential processes, there are basically 135 things that can go wrong between starting a process and ending it. So I'm going to pull up there so that we can actually get into blockchain and the questions that Josh has put together, which I think are awesome. I'm around afterwards if you want to kind of dig into any of those examples. But I guess the final message that I'd leave you with is that there are no silly questions. Let's make this panel as interactive as possible. You've had Pip and I for 20, 25 minutes speaking at you. So yeah, really welcome as much discussion as we can have this evening. Thanks very much.